the setup for a potential softish landing, how challenging will it be to get all those ducks in a row?
I think it's going to be challenging, but I think we have to recognize that over the past few weeks, we've seen signs from all of the major economies that things might be a little bit better than we expected early last fall. In the US, for example, we're now seeing real cooling in wage growth. The last report down to about 4.6% year on year, which I think is encouraging overall, even in the context of lower unemployment and still pretty substantial consumer demand. In Europe, the slightly better news is that the weather has been more mild. Gas usage is down in Germany quite substantially, and the fears that this energy shock coming from Russia and the Russian sanctions would tip Europe into a recession is much more alleviated right now. And, a recession, I think, remains likely for Europe, but maybe not quite as severe. And then, of course, in China, we have a reopening of the economy that's leading to a very ugly and bumpy set of rise in infections and maybe deaths, but a year ahead that is likely to see most of the COVID impact in the rearview mirror, and perhaps a recovery in consumption and pent-up demand in China. So from all three of those major economies, there is a glimmer of hope, even though we have to admit that's a glimmer of hope going into a slowing global economy with real risks in a variety, real risks that remain on the horizon.
So for China, would you characterize that as obviously short term, say the next quarter, we're still going to see quite a lot of challenges as the reopening plays out over the next year, perhaps more of a better picture, but the longer term issues, the demographic issues, the property sector, the debt burden as they continue to lean on fiscal to revive the economy, are these still longer term concerns for investors?
Those are very long-term, those are very real concerns, and obviously will play into not just the longer term, but the strength of the recovery this year. I mean, the property sector has been at the heart of China's growth for decades now, and that, even if things have stabilized, or we've seen a real strong recovery, certainly in those listed names, the property names in China, we don't expect that to be a central driver of Chinese growth. But I think, what we saw in the US, what we saw in Europe with household savings that have been building up during the lockdown, and then this pent-up demand that gets released, we should expect at least the balance of this year to probably exceed current forecasts or forecasts that were locked in at the end of last year.
Christopher, of course, one of the key risks for China is always geopolitical tensions as well. The World Bank now talking about China, and of course, they mentioned the real estate sector being a stress on the economy, but also, of course, trade fragmentation. As we have seen this ongoing press conference between Presidents Biden and the leaders of Mexico and Canada, we continue to see more signals that perhaps we could see the veering away from supply chains in Asia towards this part of the world. To me, a lot of that sounds very inflationary, especially when you're talking about building redundancies. Tell us a little bit about what these structural changes actually mean for the broader economy.
Well, I think that's something we're trying to watch very closely because, if you're trying to compare what the post-pandemic is going to look like, post-pandemic world is going to look like compared to the pre-pandemic world, one of the big changes is exactly what you're talking about: reinvestment in, greater redundancy, reinvestment in supply that's maybe closer to home. It's hard to get a good sense of the overall impact of all this because I think, most of this focus is on the tech sector, semiconductor spending, and those areas deemed to be very important for national security. Again, I think it's unlikely that anybody's going to feel like we have to buy all of our lawn chairs and kitchen furniture from, a strategic supplier within the United States or Canada or Mexico. So I'm not sure that the macro impact is going to be so significant, but certainly there is going to be more spending and more costs in the system in those sectors.
When you have those national policies, whether it's here in the U.S. with that CHIPS Act and $50 billion of investment commitments, or China itself trying to really gain self-reliance when it comes to the high-tech sector, does that alter your investment recommendations about perhaps some of those sectors that may be shielded from potential recession concerns this year?
Well, I think the tech sector in particular has added risks, not just because of the slowdown globally, but it's not, even before the pandemic, tensions were rising between the U.S. and China. There were regulatory concerns and crackdowns within China on the tech sector. U.S. was ramping up different kinds of sanctions, and those, I think, will continue to escalate. And so if you're operating in that space between the U.S. and China, which most of the tech sector does, or much of it does, then I think that is going to add to the risks on both sides. Having said that, what you mentioned earlier in terms of both governments are going to do a lot more spending to recreate redundancy, that's going to certainly cushion the blow of those political challenges.